Right. We are ready, so we can start. I think most of the people have joined the session. I see more than 90 people have already joined, so we can start. Okay. Before I move, remember I requested you to do something. Can anyone remember? No? No one remembers? Any idea? I see a lot of people here. Probably I may call by name, but I don't want to, I guess. Does anyone remember what I told you to do last week? No? No one? I think I asked you to look at the budget speech. Yes, yes, Asma. I told you to go through the budget speech. So, were you able to do so? Has anyone done it? Couldn't hear properly. So, what I asked you to go through the budget speech, the government budget speech. Uh, is that so? It's not clear what I'm talking. Somebody is saying it's not clear. How about others? Can hear, yeah. A lot of people, I think they can hear. Probably, I'm not so sure why your line is not so clear. So please check. Thank you, Sandali. Yeah, it's clear, I guess. Uh, so I asked you to look at the budget speech. Now it seems, I think you have not taken it very serious, or probably you may have forgotten it. Now, what I am telling you now, uh, take this week also. We have, I think, 2 weeks from this point onwards, because next week we don't have classes. It's the Christmas holiday, long weekend. So we are not having classes next week, either Saturday or Sunday, no classes. So you have some free time. So I'm not asking you to do anything during your free time, but since you have 2 more weeks, so let's try to do something, right? This is important because we need to understand what is planned by the authorities or the government in terms of financial sector developments for the next year or in the following years. So please go through the budget speech. So I'm typing it here very clearly. Budget speech 2021. It's already announced. It's already passed in the parliament. So it is actually in the process of implementation. So when the budget speech is basically implemented, proposals therein will be implemented in the coming year. So some of these proposals would be very important for us. For example, some government policy changes like in taxes. So those changes will affect our activities, the financial sector, and our performance of the financial sector, especially the banking sector. So please have a look on the budget speech. So I think tri-language document available on the ministry website. Uh, uh, finance ministry website, so it is easily downloadable. So please do that. And I have a copy of the budget speech with me. uh, I'll try to share. If not, I think it's very easy for you to get a copy of that. So can you do it, please, next week? You have 2 more weeks.
Sure, sir.
Yeah, thank you. So we'll do it next week because we are going to discuss it. That's the thing. What are the proposals? What would be the impact? How it's going to change our financial sector activities? So that's really important. So please do it. I'm giving you another time extension, uh, so you have some time. So let's do it next week after actually. So our next class will be on, I think, January 2nd, if I'm not mistaken, next weekend, Saturday, January 2nd. So on that day, we will have a discussion on that. So with that, we'll go to our slides. I hope you can see my slides. Can you?
Yes, sir.
Okay, thank you. So I think we stopped somewhere here. We were talking about basic elements of the financial system, and we looked at various aspects starting from the financial authorities or the regulators in the financial system. Then we looked at financial institutions, markets, products, and so on. And we stopped at the financial infrastructure. So financial infrastructure is basically for the purpose of facilitating financial transactions. Now, for example, if you want to exchange a financial instrument, let's say you are buying a bond, and how that will happen? You have to make a payment, and that bond will be transferred to your account, the ownership. For that matter, you have to have some infrastructure to facilitate the transaction. So the financial infrastructure is available for that purpose. Now in Sri Lanka, as I said, the main responsible agency for providing financial infrastructure, which means payment and settlement facilities, is the central bank. So central bank is providing a various kind of or a wide range of infrastructure. In this slide, you will see there are a lot of systems available like check clearing system, fund transferring system, real-time gross settlement system, scriptless security settlement systems, etc. Most of these, I think I drew last week a kind of a circle. You take this entire infrastructure, this much of infrastructure is basically provided by the central bank, right? And these two are basically provided by the CSC, or the Colombo Stock Exchange, or the Securities and Exchange Commission. So they are providing those two systems. Other than that, most of the systems are provided by the central bank. So in the economy, we have various transactions, ATM transactions, credit card payment, fund transfers, where you process various fees and payments. Most of these things are actually done with the facilitation of the central bank. So let's very briefly look at some of these systems available in Sri Lanka for the purpose of payment and clearing. Now, in the central bank, or at the initiative of the central bank, there is a major system called Lanka Settle system. I think if you are a banker or if you are a player of the financial market, some of you may have idea about this system. So the Lanka Settle is the largest and payment infrastructure in Sri Lanka. It has two subsystems, real-time gross settlement systems, in short we call it RTGS, and also there is another system called scriptless securities settlement system. So this is basically, if you look at this term, you will see it is helping to settle the securities. If you look at the RTGS, it helps to make payments because it's a real-time payment system. So in the RTGS system, basically large value payments are processed, or large value payments are done through the real-time gross settlement system. We have a separate session on these systems, but I'm telling you these terms time to time. In our discussion we use these terms, so you need to know what is meant by those terms. So that's the reason to have a brief discussion even at the beginning on these terms. So RTGS, as I said, it's for large value payments. Let's say if you want to transfer 500 million, you can't use a check. You can't even use your simple fund transferring mechanisms because it's huge amount. So such transactions are done through the RTGS system. So this is facilitated by the central bank. And the other system under the Lanka Settle, as I said, scriptless securities settlement system. Scriptless securities means basically treasury bills and treasury bonds. So these are government securities. Now in Sri Lanka, the largest securities market is for the government securities. The reason is the government is the largest borrower in the economy. So their debt portfolio, if you have followed the numbers, is something like 13 trillion. 13 trillion means, we know a trillion means 1,000 billions, right? So 1,000 billions multiplied by 13 times. So it's the debt stock of the government. And of that, I think closer to 0.5%, 50% actually, closer to half, roughly 7 to 8 billion is domestic government debt instruments. Domestic government debt instruments means basically treasury bills and bonds. So you can imagine the size of treasury bill bond market. It's very large. So the purchases and settlement of these treasury bill bonds are happening through the scriptless securities settlement system. Now we use this term scriptless because there are no documentation involved. In other words, these treasury bills and bonds are not available in script forms. So there is no paper securities. All are actually electronic entries, electronic recordings of the transaction. So securities are available in scriptless form. That's why you call it a scriptless security settlement system. This is coming under the Lanka Secure system. So here we use the term Lanka Secure. So Lanka Secure has this scriptless security settlement system plus another system called CDS. That is the depository, right? So we are not highlighting here because the main payment mechanism or the settlement mechanism is the SSS system, SSS system, right? So that is the main system in Sri Lanka. Lanka Settle, that has two components, RTGS and scriptless securities settlement system. The second one, Lanka Interbank Payment System, SLIPS. This is for small value payments. Now, I think SLIP system is very familiar to you. If you are working, you know how your salaries are paid to you, right? Now, in the past, we know salaries are paid by the accounts branch of a firm. So you have to physically go there and you have to collect cash physically. Or sometimes I think back later, the banks, they were, taking money in a, large briefcase or, in large quantities. They go to a bank and deposit. And the bank will process us on behalf of you. So the salaries will be credited to you. So both are actually very cumbersome. We know collecting salaries from the counter and also transporting money to the bank by a company is really a difficult task. So to address that, the central bank has basically introduced this slip system with the support of Lanka Clear. Actually, it is basically operated by Lanka Clear. The Lanka Clear is it's a private company, but it is with the support of the central bank. The central bank is also a shareholder, and it was established with the support of the central bank. So the Lanka Clear is providing this slip system for small value payment. So now, if you observe, companies are directly crediting your accounts on the salary day. So how it happens? So the company will send the details of the payroll to the bank with the money, and the bank will credit to individual accounts based on the instructions. Okay. Third system, one of the important systems we have in our country is CIT system is basically for the check processing. So in the past, we know checks were basically collected physically, and those were transported to the clearing house, and the clearing house will be in contact with the particular banks who has sent the check, and that was cleared basically in a manual way. Now, banks are not sending those checks to the clearing house physically. So physically, none of the checks are coming to the clearing house. Instead, the bank will take an image of the check, and that image will be transferred to the clearing house. So thereafter, the clearing happens. So likewise, it has been improved in terms of uh, taking an image and transferring that image to the clearing house without manual involvement. So as a result, the clearing or the settlement gap timing has largely improved. I think in the past, if you deposit a check from far away, that would have taken 2-3 days, even a week. Now I think most of the check payments are done on basis of T+1, which means on the following day checks are basically clear. So these are the main systems operated in the central bank and the Lanka Clear with the support of the central bank. And as I said, there are some other systems as well. Now, for example, another system that we have SEFT, right? So through the SEFT, this common ATM framework, ATMs, POS, which means point of sales, when you use a credit card at a particular vendor, that clearing is basically done through the POS system, ATM system, and there are common payment gateway are under discussion. They are basically underway. And recently, if you look at the QR code, it was introduced, which means the payments are done through the using the QR code without having any involvement of cash. You simply have some contactless payments. You only use the payment and a barcode for a QR code to scan and make the transaction through your bank account. So likewise, a lot of financial infrastructure is basically provided by the central bank in Sri Lanka. So we have a very detailed discussion later on this. Okay.
Sir, can you repeat that third one?
Check
CT,
imaging and truncation.
CIT.
Yes.
Yes.
That's basically earlier, as I said, the check processing, check settlement was done in physical form, which means you transport the check. Let's say you receive a check as a bank from a customer. So in the past, every day the bank was basically sending these checks physically to the clearing house. Clearing house means basically the central location where all checks come. So that took some time, and it's a painstaking activity, right? Painstaking activity, because you have to do it very manually and takes time. But later on, under the CIT system, you take an image, right? You take simply a photograph of the check, and you transmit that photograph to the clearinghouse in a secured way. So when the clearinghouse, the Lanka Clear system, receives that check through the online basis, or through the electronic basis, they clear it. And as a result, by contacting respective banks and their accounts, and as a result, the processing time has reduced. As I said, now it's something like T+1, which means you deposit a check today, it is basically cleared on the following day, right? So that system is, you call it CIT system. Clear?
Yes, sir.
Okay. So we'll have a detailed discussion later when we come to this particular topic in a particular future date. The last item of this slide set is the latest, or the most uh, latest discussion on an important component of financial system, that is safety nets. Now, safety nets, in the past we didn't talk about safety nets in detail. There was no significant focus on the safety nets. Now we talk about safety nets, especially after one particular incident. I think you all are aware, in 2007-8 period, we observed a global financial crisis throughout the world. The impact of the global financial crisis was felt because of the severity and the magnitude of this crisis. And I think we have a separate session on this crisis. We will discuss in detail. So after this crisis, countries, especially the central banks and governments, they realize the importance of stressing the need for a safety net. Now, safety net is simply, the idea is a kind of a protection. Now, I hope you have seen, these circus arenas, right? Have you watched any circus? We don't see live circus these days, but even in television, probably you may have seen. So when these, artists, circus artists, are performing in air, they have a, safety net underneath, right? So if by any chance, by accident, they fall, they are protected by that safety net. So in the financial system also, we have a similar net as a protection. So what are these safety nets, financial safety nets? I have defined it here. Resolution and protection frameworks to ensure stakeholders in the financial system. You can add some more points here. Ensure stakeholders in the financial system are safe and protected, right? Safe and protected means their funds, money, are basically protected. That is the idea. Now, that is needed in the economy, in the financial system. No one will take risk, because money, finance is basically dealing with risk. People will not take any risk or will not make any investment if there is no such safety net, no protection mechanism, no resolution systems. So that's why we need to have these protection frameworks. So that is simply a net to ensure financial system stability. Now, there are some elements under these safety nets. One is effective bank regulation and supervision. I think we talk about this regulation even at the beginning also. Regulation means simply you monitor, supervise, and you are trying to, uh, uh, make the financial sector players very disciplined according to the, set rules and norms, right? So that is a part of safety net. Because if all financial stakeholders, especially institutions, follow these regulations, the regulations are made for good. That is made for the benefit and the safety of the financial system. So I think if everyone follows, we will not have any issue, problem. And then we have deposit insurance schemes. Deposit insurance schemes means if a particular financial entity or institution is failed, the deposit insurance scheme will give you some, concession in the sense, at least a part of your deposit will be recovered, paid by the deposit insurance scheme. So that is a kind of a insurance protection for your deposit. Third item, there are emergency funding facilities, financial facilities. Actually, deposit insurance schemes are available for depositors, right? Emergency financial facilities are available for financial institutions. For example, let's say a bank is in a trouble. They are not having enough liquidity, enough money. They don't have money to pay for their depositors. They don't have money to settle their investments for their people who have invested in their securities. So in such cases, emergency financial facilities are available for them mainly by the central banks. So central banks are the main providers of these, not CBSL, but basically you can say central banks, basically providing these facilities in an emergency. Effective crisis resolution policies means if there is a crisis situation, if there is a very worse situation, there should be some mechanisms to bail out. Resolution means, the idea means, resolution means bailout. Bailout means you rescue. Resolution, the idea is you rescue. For example, some way of rescuing is basically if a company is in trouble, you try to sell it to some other investor. Or you try to infuse capital through another investor. Or maybe even the governments can, bail out. They can put money, especially during global financial crisis. In Europe, a lot of governments put money to rescue financial institutions. Central banks can do resolution. So these are, in the worst case, crisis resolution policies. Okay, so those are some elements of safety nets. In Sri Lanka, the central bank is operating a similar safety net. In Sri Lanka, we have a system called Sri Lanka Deposit Insurance and Liquidity Support Scheme. Now, SLDILSS, in short, this is to support financial institutions and depositors. Now, under this deposit insurance scheme, if a particular regulated financial institution is failed, the central bank is, paying depositors based on their deposit money. So maximum at present in Sri Lanka paid through the deposit insurance scheme is 600,000. I think it started with 100,000, then increased to 300,000. Now it is 600,000. Now this is actually may not be covering your entire deposit, but at least some good portion is paid, and we observe 90% of the deposit holders in failed institutions are covered by this 600,000, which means they are very small deposit holders. So their deposits are mainly covered by this amount. And if it is, possible, it has to be increased. Basically, this is run through, contributions of the financial institutions. So they are contributing to this deposit insurance scheme. So when the contributions are, increased and the fund is grown, the 600,000 can be increased further. But for the time being, the deposit insurance covered under this scheme is 600,000. And also liquidity support scheme, under that, banks can access, finance companies can access the central bank asking for some support for their liquidity issue. So this is the main mechanism in Sri Lanka. And in addition, in Sri Lanka, we have a crisis resolution framework, which means a kind of a resolution department is there at the central bank. And probably if you watch the financial news, you might have seen a lot of actions are taken by the central bank to wind up some companies, to close down, to restructure, right? That is a part of safety net. Final point I want to highlight here in this discussion towards the end, we will be talking about financial system stability. That is a very important area because end of the day, we are worried about the financial system because we have seen there is a great link or some strong link with the financial system and the economy. So as a result, if something happens, that will have an impact on the economy. In other words, if the financial system is weak, the impact will be felt by the economy. So as a result, we need to have a strong financial system or stable financial system. Stable means it has the ability to face shocks. It has the ability to withstand the shocks. The shocks can be, internal shocks or outside shocks. Any type of shocks emanating in the financial system or in the economy. So if a financial system can, absorb that shock or face that shock, that is a stable financial system. It is needed because that will create a stable environment for depositors and investors. Because we know the financial system is basically nourished or supported by the depositors. They are the savers or the surplus sector, right? And investors, people who are bringing money for investment purposes. So we have to create a good environment for them. Okay, and also we can encourage financial institutions, markets to function in an orderly manner, efficiently manner, because efficient financial intermediation or the role of the markets are really important for the economic performance. So all in all, that will promote the financial system stability, will promote investment and economic growth. So for that matter, we have to ensure that financial system is stable. In other words, although there are temporary ups and downs in the financial system, there could be some temporary variation shocks. Broadly, the financial system does not indicate any vulnerability, or it does not affect the stakeholders of the financial system. So that is the last point that we will be discussing in this session, okay, in this entire course. So I think I have listed down so many actions taken by the central bank to ensure financial system stability. I think most of the things are very straightforward. I have already covered. Regulation I have discussed. Resolution I have discussed. Resolution means bailing out weaker financial institutions. Market infrastructure I already discussed. Safety nets I already discussed. The only thing I have not discussed or not mentioned here is the second point, macroprudential surveillance. That will be also covered in detail under this financial system stability discussion. There actually what we are talking about is financial system is basically monitored as a whole. So entire financial system and monetary system is monitored to identify systemic risk. Systemic risk means the system-wide risk or the broader risk in the financial system. Now, earlier, the central banks or the regulator, they were basically doing some microprudential surveillance, which means microprudential means the word micro indicates individual. So banks were monitored individually in the past. Financial markets, their players were basically individually monitored or regulated. Even now it's happening. Microprudential supervision or regulation. But on top of that, we have a new term called macroprudential supervision or macroprudential surveillance, which means you are observing the financial system as a whole to identify any systemic risk. So, in order to avoid these systemic risks, the central banks or the authorities are following macroprudential policies. So macroprudential policies, as I said, targeting the entire financial sector, not one institution, not two institutions, not one market or two markets, few markets. It is targeting the entire financial system. So after the crisis, especially, many countries have focused on this macroprudential surveillance. In Sinhala, we use a term Sarva Vichakshana. Vichakshana means the prudential. Sarva means macro. So macro prudential indicates the Sarva Vichakshana means you look at as a whole. Sarva, the idea means as a whole. You monitor and take actions on the financial system as a whole. Right. I think with that, we are done with our introductory session. Our introductory session went for 2 weeks, actually, 2 sessions. But that does not, affect our, future discussions, because probably you might think introduction took 2 weeks. Why is that? Because we need to have a very solid, sound understanding about the financial system and its components. So even though this is a kind of an introductory session, I have, broadly covered the entire course that we are going to follow. So in the future sessions, in the upcoming weeks, what we are doing is we are basically drilling down to each and every topic to understand them in detail, right? So that is the purpose or the plan for the coming weeks. Before we move to the next session, does anyone having any question, anything to be clarified? Any question? Can you hear me? Any question? Any clarification? All clear? Can we move to the next part? Asma, no sir means it's not clear or clear at all? When you say, okay, clear, right. So which means we can move to the next session, right? So let's move. Now, next session, we are moving to an important area. Money. So this discussion is a bit lengthy. I would say roughly we will be discussing money and related matters for nearly 1 month, which means roughly 4 sessions. The reason is very clear. In your paper, in your exam, the money and related matters are given a significant weight. In other words, I think if you take your entire syllabus, 1/3 of the syllabus and the exam paper, 1/3, closer to 1/3 is related to the discussion on money. So money and its related issues. So as a result, we also have to have a very detailed discussion on money spanning for many weeks. So I think starting from today, roughly till mid-January, we will be talking about money. So I really urge you or request you not to miss these sessions, because in this section under the discussion of money, we have some uh, sections or some parts in terms of doing some calculations. We need to do some calculations, some small maths in the sense we need to compile money supply, we need to look at the growth rates of money supply, we need to understand money in detail. For that purpose we are doing some calculations. If you look at your exam paper also, you will see there are some questions related to money. Okay, so that's why we need to have a detailed discussion and be prepared uh, with the calculator also, right? Calculator and some extra paper to do some, extra, to take some extra notes, to do some questions, past paper questions. So be prepared with a calculator. The basic calculator is fine. So if you don't have a calculator, you can have your mobile even. Or if you are really genius, you can use your brain, mind, without having a calculator. But some method of uh, support is needed to do calculations. So I hope you have the handouts with you and the note. I think I uploaded a note also on the concepts of money. Have you received it? Did you check on LMS or the Moodle?
Yes, we received it.
Okay. So let's move on. Now, money is an important component of the financial system. I think every one of us, we have connection with money, right? We have a connection with money. One way or the other, we are very much close to money. So maybe when you were a kid, you were not that worried about money. It's only a toy when you were a kid, right? So when someone gives you money, it's a kind of a some gift to you. But as you grow, you may have realized the importance of money. And by now, being into the market and the economy as members of the workforce, and people who are seeking for employment and who have already opted to up to some employment, they might know the importance of money. So today, if I ask you to list down the priorities in your life, I think most of you would say money is an important priority. That is the reality, right? Someone would say, no, I'm not, I'm for working for the country, working for betterment of our nation or whatever, because of the patriotism or various reasons. But the underlying reason, the underlying rationale, we as economic human beings, we love money, we like money, right? So that is reasonable, and there's nothing wrong with that, because money is an important thing. From the last 2 weeks discussion, we have seen the finance and money, they are the backbone of the economy. So as a result, we have to have a very good understanding of money, and also we should learn how to manage money properly, how to uh, earn money properly, and also how to love money, love in the sense how to basically use it for our day to day activities and how to resave them. That is also important. So that's why we are taking this important component in this discussion, money and the central bank. So we are talking both together. So in the first two sessions, I'll be basically talking about money. In the next session, I'll be talking about monetary policy. And then in the following session, I'll be talking about central bank. So all three are pretty much related to each other. So let's start with the discussion why money and the central bank are relevant. Because money is the foundation of the financial system. We have seen it. Why it is called as the foundation of the economy? All transactions of the economy are based on money. Now, money can have different forms, right? It can have, various forms, like can be currency form, can be in virtual form, can be in electronic form, can be used as, checks, payment methods. So can be any form, but money, if you take as a whole, in general terms, it's the basis for transactions in the economy. Why it is the basis for the transaction of the economy? Because money is accepted by everyone to do the transactions. So as a result, you call it as legal tender. Money is the legal tender. Why? It has the legal backing. No one will accept money if there is no legal backing, right? Just a piece of paper cannot be money. Why? There's no legal tender. Just a piece of metal cannot be legal tender because there's no legal backing. Any other good, like or a pen or a book or whatever, cannot be money unless you have legal tender. So the legal tender is coming from the government actually. So government is endorsing a particular asset as money through law. For example, in Sri Lanka, our money currency is rupee. So that rupee can be in various forms, right? It can be currency, it can be deposit, it can be electronic form, whatever. So that is basically considered as money accepted for transactions because government would say that is money. It has the legal tender, legal backing. Okay? So that is really important. That legal tender is given by the government through the central bank. That is the relationship between these two, money and the central bank. Central bank is issuing money on behalf of the government. So government authority is given to the central bank and the government has endorsed it because in money, if you take simply a currency note, you will see in Sri Lanka, the finance minister basically he signs on the note. Central bank governor signs on the note. That is not the case in every country, but we assume that the government has given its authority to the central bank to issue such money. Okay? So legal tender is really important. So I mentioned two important points. It is the foundation of the financial system and it is the legal tender for transactions. Third point, it has taken different forms in the history. Throughout the history, if you look at, I think we will be very briefly discussing the history of money. Throughout the history, we have seen money has taken different forms. Earlier forms of money, they were not currency. Maybe a animal in the primitive age of human civilization. At some point, we use cow or shells as money. Even we use simply stones that you can find from the environment, from the beach. you use them as money. So depending on the stage of the development of the society, money can take different forms. Now today we are in a digitalized world. We are basically, even our teaching now we have become, virtual teachers and students, right? So our relationship is basically virtual now. In the past, we meet in the classroom. We know how you behave and how do you respond, and how does the teacher performs his teaching function. Nowadays, you cannot feel him, observe him, and even the students cannot be observed. So basically, we have moved to a kind of a virtual world, even especially with this current situation. But even without that, we are basically in a digitalized world. So in a digitalized world, we are talking about digital currencies, right? Money that doesn't have physical feature, or it is not in physical nature. It's in virtual form. Form means the money is in simply in computers or in the air, in the cloud, right? So it has taken that form, depending on the stages of development of technology and human society. But main point, it has always been important to people and the economy. So irrespective of the form of money, it supports the people. It supports the economy. We already know how it supports and why it is important. So it is an important commodity. Money is an important commodity. And I already mentioned money and the central banks are closely related because central banks have the control of money because they issue. Central banks are issuing money. So since they issue, they have the control. So I think if you take the entire world, more than 95% of the countries, I would say closer to 100% countries, maybe only one or two exemptions, the central bank issues money. There are some countries I can't remember, but the treasury, the government is issuing money. But in most cases, the central bank is, I think in majority of the cases, central bank is issuing money. So central banks are the prime responsible agency to issue money. Prime responsible agency to issue money. Now, why do you say prime responsible agency? As I said, it has the ability to issue money by law, as I already mentioned, and also it has the ability to control money. That is very important. Why controlling money is important? Because in the economy, we cannot inject money as we want, which means we cannot inject excessive amounts of money to the economy. Why? There are some macroeconomic implications, some adverse implications when you have excessive money in the economy. So central bank has a role that the central bank does not allow excessive money to be injected to the economy. So that role is basically given as the ability to control money. So central bank issues money and controls money. That is very important task played by the central bank. So as a result, there is a close relationship. So this part actually we will be discussing under monetary policy when we move forward. Okay. Let's define money. Money, very simply, you can define it as any asset that is acceptable, generally acceptable, as a medium of exchange and for settlement of or repayment of debt. So when you define money, I think in most cases you will see this part, any asset that is generally acceptable as a medium of exchange. I think that indicates the key function of money. So as a definition, it is sufficient. But to sake of completeness, we have added this part O for the settlement of repayment of debt. Why is that? Now, if you diagnose this definition, or if you decompose this definition, you will see money is an asset. Can be any asset. As I said, it can be a cow, it can be a stone, it can be a shell, it can be a book or a pen or whatever, any asset, any good commodity. But it has to have these features. What are the features? Most important feature in defining money is this part, generally acceptable. So general acceptability is the most important. It should be accepted by everyone. Everyone means in a particular community, everyone should accept that asset as money. So if you are using a paper, everyone should accept that paper as money. So as long as they accept, you can use it as money. How that acceptance comes, as I said, because government would say, okay, this is the legal tender. So when you have that, that becomes generally acceptable. Generally acceptable for which purpose? As a medium of exchange. Medium of exchange, which means you can use money for exchange purposes. Exchange purposes means you can give money and receive goods and services. In other words, payments for goods and services are facilitated by money. So the medium of exchange, the idea behind the medium of exchange, it allows payment for goods and services. So that is the most important part of this definition, right? I would say this part. And as I said, if any asset can be used to settlement or repayment of debt, that is can be considered as money. In modern world, we settle our debt using money. As I said, the form of money can be different, but we use money, isn't it? For example, you take a loan from a bank. You take 100,000 from a bank. How do you repay? So when you repay, do you repay in any other forms or good? Will you return it as a let's say a cow or a whatever some other gift or a service? No, you are returning your debt as money. You are repaying your debt as money, using money. So that's why you call it repayment or settlement of debt. So I think the definition is much clear. And I have to clear a couple of points here related to the definition of money. If you look at the smart art on the right hand side, I have made few points there. What are these few points? First one, money is not wealth or income. When you say you have money, that does not indicate your wealth or income. Why? Wealth can be in any form, not only money. So wealth can be money or precious metal, precious stones, even real assets, right? So if you look at the past, people had wealth in many forms, right? Gedora, ida kadang, watu piti, harakabana, patal, manik, etc., etc. So many things. So money is only one part of the wealth, and it is the major part because people would accumulate money because it is very liquid. So in the total portfolio of wealth, if you take, money is an important part. Other than that, you can have various other forms of wealth. As I said, you can have metals, gold, you can have gems, things like that, precious stones. You can have real estate. You can even have financial securities, right? Those are also part of wealth, and money is an important part. So it's clear, money is not wealth, it's a part of wealth. And money is also not the income. So when you have your income, you cannot say you are having money because of one major difference. What is the key difference? Money is a stock variable, right? It's a stock. So at a particular point in time, you have stock of money. That stock maybe you derive from your income, or maybe some other way. Not only the income, you can have money through borrowings, as I said. So if you borrow, that is also part of your money. So that is also part of your stock. Income is basically what you generate out of an activity. So it's a flow variable. Income is a flow variable that can change, and that is over a period. So that is the first important point. Money is not wealth or income. And the second point I already mentioned, touched upon that, money is the most liquid asset. Most liquid means, I think I defined last week also, we have discussed this liquidity. I told you liquidity means simply the ability to convert it to money. So when you take that definition, the money is the most liquid asset means the speed of converting it into cash form. So money, you don't need to convert. It's already in cash form or money form. So people say money is the most liquid asset means people say it's the 100% liquid asset because it is readily available for transactions. You don't need to convert. If you have cash, you can go and just buy any good or a service using money. But other assets, they might not be that liquid. Now, for example, here in this pie chart, we have identified other assets, metals, gold, or other gems, real assets, financial securities. None of these assets are 100% liquid. Only money is 100% liquid. Why these are not 100% liquid? Because you cannot convert as in a hurry. Can you sell land in few seconds? No. Can you sell a financial security in few seconds? Can you convert it to money? No. It takes time. You have to go to the exchange. You have to find out investors. You have to look at prices. Prices should match, and fund transferring should happen. A lot of things have to be completed. So money is not like that. It is highly liquid. Third one, we already mentioned this point. Money is universally recognized, accepted. People are accepting money for their transactions without any hesitation. Universally accepted, universally recognized. In singular, there is a nice word for this. I think probably you may have heard sarva. I can't write singular here very properly. Sarva pratigruhitatav. Right, very complicated term. But the idea is everyone accepts, universally accepts. Now here, when we say universally accept, there is a small caveat or some exception that we have to understand. Even though you say money is universal, recognized and accepted means, that does not mean your your currency can be traded anywhere in the world. It's not the idea. For example, our rupee cannot be, used in US to buy goods and services, right? Because our currency is not a hard currency. No one, or generally, it's not accepted. So the idea here is money is universally recognized and accepted within a particular community, in a particular society. In our society, it's accepted by everyone. Even a foreigner comes and wants to make a payment, he has to use our currency because he has to convert that into the local currency, which is the locally accepted currency. And as I said, there are some global currencies can be used anywhere. Dollar is a global currency. Sterling is a global currency. Euro is a global currency. So it has universally acceptance everywhere. But here the idea is within a particular community. Last point I want to mention here, money is a liability to the issuer. Now we mentioned money is an asset, any asset. So this becomes an asset to the holder, right? So if you hold money, that is your asset. If it is with you in your possession, that is your asset. So the money holder holds money as an asset. Now, for example, if you take a balance sheet, if you have a balance sheet, very simply, if you prepare a balance sheet, a T account, on your asset side, you might have cash. Cash means currency. Might be you have taken this currency as a liability of a loan, right? As a loan. You take 100 loan and that becomes 100 cash in your balance sheet. So it is an asset for the holder. It's a liability to the issuer. So money we already know issued by the central bank, right? So central bank or the government, we can say broadly the government, when the government issues money, the central bank through the central bank, it is a liability to the issuer. So if you take the central bank balance sheet, assets and liabilities, money is mentioned on the liability side. Cash or currency, notes and coins is stated as a liability. So not only the central bank, there are various forms of money. Even deposits can be part of money. So if they are part of money, the issuers of these money will record them as liabilities. In other words, if financial institutions like commercial banks, they are issuing money in terms of deposits, they are also mentioned as liabilities, right, in their balance sheet. Clear? Any question someone want to raise at this point? Can we move? If you don't have any questions, I hope you are listening. Does anyone want to raise a question? I heard some voice. No? Can we move? Right. Next point, we already know the definition and the key features of money. Functions of money. This is a very traditional discussion. I think if you look at textbooks, you will see in any textbook you find these functions. Money can be used for various functions. Out of these various functions, we identify four major functions, or you can call them as primary functions of money. So what are these primary functions? I think two of them we already know. Money is a medium of exchange, and also we have identified it as a method of paying debt. Those two we already know. So in addition to that, we are introducing two more functions here. Money is a store of value and unit of account. So altogether, four functions: medium of exchange, store of value, unit of account, standard for deferred payments, which means here what we indicate is standard for deferred payments means paying debt. Okay? Deferred payment is debt. So let's look at these functions, what is meant by these terms. First one, money is a medium of exchange. We already know. We mentioned money can be used to buy or sell goods and services. Not only goods and services means finished product. We can also use money to buy factors of production. In order to produce, we have to deploy factors of production. What are these factors of production? We know land, labor, capital, entrepreneurship. Those are the four major, functions, four factors of productions. Out of those two, at least we talk about two major functions, L and K, land and capital. So those factors can be purchased or sold using money. It's important. Why it is possible? We know money makes it easier because it is universally acceptable. Universally acceptable means we give a very clear definition because it is accepted in a society. So if anything is readily accepted as a payment, that can fulfill the medium of exchange function. So that's why I said at the beginning, even though some forms of money in the primitive age, like stones, like shells, they were accepted as money because it helped to fulfill this function, medium of exchange. So you give simply a shell, you buy whatever you want from the other party. So that facilitated the exchange. So one of the key functions is medium of exchange. Second, money is used as a store of value or wealth. I already mentioned to you, people save for future for many forms, in many forms. Can be land, gold, gems, securities, etc. So there are various methods of using or saving for money. Now in modern day, people use virtual currencies to save, like bitcoins. That is also a method of saving for future. So there are various forms that the people use to store value for the future. But the issue is when you liquidate these assets, liquidate means when you sell these assets in a future date, you might incur different losses or gains. So when you invest or when you have those assets in place as storage of value, it could lead to losses or gains in the future because of the issue of liquidity. I told you, if it is very liquid, that is ensured that you will not have, losses. But we don't know. Sometimes these assets may not be liquid. I already mentioned to you, lands you cannot sell easily. Probably you can sell gold easily, but you might incur losses. Securities you might sell it quickly, but probably you might incur losses. So that uncertainty is there. People use money as a store of value or wealth because it is most liquid. So people consider accumulating money as an asset is very efficient, because when you have money, you can easily use it for, purchases or any other transaction in the future. So I think even us, we have very different types of assets with us. For example, we might have assets in terms of real assets or maybe gold or whatever. We would like to have assets, but at the same time, we are keeping some amount of money as assets or future value, store of future value, because it's liquid. Okay? But it has a problem. Storing value using money has a problem because the value could erode over time. Probably you may have heard the term inflation. Inflation means what? Can anyone suggest a definition for inflation?
Inflation is increase in the price level.
Exactly. Who was that? Suddenly. Yeah, thank you. Very correct. So inflation is increase in price levels over time. We know prices are not static. Static means they are not constant, right? They would change over time. So that change, if you measure, that is simply inflation. I will define inflation in a technical way when we talk about monetary policy. But for the time being, as Sandali also very clearly mentioned, let's take it's the price change. So when the prices are changing, which means prices are, for example, increasing, you call it inflation. Why it is a concern? When prices are increasing, the value of money will decline. For example, if you have 1,000 rupee today, due to inflation, price increases, in 5 years' time, that 1,000 rupee might not have the same value. Okay? That's why people used to say, okay, in our time we spend 10 rupees to watch a movie, have a lunch, to go on a picnic, to do a lot of things using 10 rupees. Today, 10 rupees is worthless. So the underlying reason is over time the value has eroded because of inflation. So when you have this store of value function of money, it is affected by inflation. So when you keep money in the form of money, wealth, if you keep in the form of money, that is subject to inflation. So that could erode. But there are some strategies to compensate for that, right? So how do you compensate for that? Let's say your money is eroded, value is eroded if you keep money in money form. What is the strategy that you can follow? You can keep this money in the form of which form, which type? You can keep it as bank money, isn't it? Rather than keeping it as currency and coins, you can deposit in a bank and you can gain an interest for that. Okay? So that interest is compensation for the inflation. Okay? That opportunity is there. But still, as I said, even inflation is affecting the value of money. Most of the people, I think majority of the people, they keep money in money form. with them, some part of money. Third function, money is considered as unit of account. What do you mean by unit of account? We can use money as a yardstick or a measurement to post prices and record debt. Now, if you go to a shop, you will see goods are priced using monetary value. For example, a particular trouser is, this much of rupees. Particular t-shirt, shoe pair is this much of rupees, which means items or goods and services are valued using or expressed in money form. So as a result, you can record them in books. For example, now probably you may have seen financial accounts, right? Accounts, financial statements. In every financial statement, you will see on top, it says amounts are given in LKR or amounts are given in sterling. Likewise, you define the monetary unit at the beginning because you record them using money. Have you seen accounts express other than money, using other than any other asset than money? For example, have you seen financial accounts? Okay, okay, this year accounts we give in coconuts. Have you seen? No. We use money to record our financial transactions. Similarly, debt, your borrowings are recorded in money form. So all measurements in the economy are denominated in money. All measurements in the economy. That's why you call it unit of account. Fourth one is a medium of deferred payment. Deferred payment, I already mentioned to you, this indicates paying debt. Right? Deferred means in a later date. I think in a Sinhala you use the word Vilambit. Probably if you have done A levels or or A levels in commerce stream, you may have studied economics or business studies. So there you discuss these functions. So in Sinhala you call it මුදල්යනු හෝමාරු මාධ්‍යයකි මුදල්යනු වටිනාකම ගබඩා කිරීමේ සන්නිධියකි මුදල්යනු අගය ප්‍රකාශ කිරීමේ ගිණුම් ඒකකයකි also මුදල්යනු විලම්බීත ගෙවුම් මාධ්‍යයකි. So in Sinhala you have those nice terms, same thing. So vilambita or the deferred means you pay in a later date. What do you pay in a later date? Basically your debt. So people enter into contracts, financial contracts, to pay in a later date. For example, especially when you borrow. So when you borrow, the creditor, the person who's giving you money, will prefer to receive the payment or the repayment in money rather than based on any type of physical asset. So he gives you money, he will expect money in return, not any other asset. So money is the most efficient way of paying debt. So I think it's clear the four functions of money. Money as a medium of exchange, money as a storage of value or wealth, money as a unit of account, money as a medium of deferred payment. So mind you, these are some exam questions. So in some exam papers, you have these questions for 5 marks. Other point I want to mention here, if a particular asset fulfills the very first function, that is medium of exchange, that usually fulfills the other three functions. Right? So if money is completing or fulfilling this medium of exchange function, that fulfill the other functions as well, naturally. For example, I already mentioned to you that in the history we used shells. So if you accept shell as a medium of exchange, that can be used to accumulate wealth, that can be used to measure the goods and services, also that can be used to pay debt. Okay? And people have done it in the past. So that is an important point. So money, I think we have some reasonable idea about its functions. Now we talk about exchange also. Now I think I mentioned to you, every country has a legal tender. Legal tender means simply notes and coins. So these notes and coins are issued by the government or the central bank by the government order, by law. So that's why you call it as legal tender, used for transactions, right? That is clear. And if you talk about the scope of money, here we simply introduce the idea that money means not only currency, notes and coins. So when I say money, so far, most of you may have thought money is simply currency, notes and coins. Right? That is the natural thing that comes to our mind when I say money. Now, it is more than that, which means money can be in other forms as well. For example, if you are doing transactions through bank accounts, when you do transactions through bank accounts, you are using some methods to do such transactions. For example, how do you make a transaction through a bank? You have a deposit, you have a loan, for example. Through these products, you enter into transactions with a bank or a similar financial institutions. So as a result, the products offered by the banks are also becoming part of money. For example, banks have current accounts or some other account types. They are also becoming part of money. And some people argue even some instruments that you use, credit cards, they are also part of money. Here we have a different argument actually, whether the credit card itself is a money, right? Or it's an instrument only. There we have a different discussion later to make it clear. But some people say, okay, the current accounts, because these are products. Credit cards, these are products. So those are also part of money. So what I want to highlight here, there can be various forms that can be used for exchange. Various forms of money that can be used for exchange. So we will be looking at those different types of money when we move forward in our discussion. The other point I want to highlight here, now I mentioned most countries they have a legal tender. Legal tender means, I clarified it, the government authority to consider some asset as money. So that is coming from the government authority. So national currency is the legal tender. Now in Sri Lanka, what is our legal tender is rupee, national currency. So different countries have different national currencies. We have rupees, India has rupees, Pakistan has rupees, Indonesia has rupiah, Thailand has baht, Japan has yen, Australia has dollars, New Zealand has dollars, USA has dollars, UK has sterling, Euro region has their euros, Russia has rubles. Likewise, there are various legal tenders across countries, national currencies, used for their transactions. Some countries, they don't have national currencies in place. They have, but people, they do not prefer such national currency for their transactions. Now, for example, countries like this Bahamas, Uruguay, Cambodia. If you go to these countries, you will see they have their own currency. I have seen Cambodian currency. It's a large currency, dark blue currency with some pictures on that. But that currency is not preferred by the economic agents in that particular country. So they prefer something else. For example, in these countries, Bahama, Uruguay, Cambodia, they prefer to have dollars rather than their own currency. Even I heard countries like Bhutan, they would like Indian rupee rather than their own currency. I have heard in Maldives, they prefer dollars rather than Maldivian rupee. So which means to fulfill their transactions, they prefer some other currency instead of their national currency. You call it currency substitution or dollarization. The word dollarization indicates people are using some other currency for their local transactions. Now, for example, in Cambodia, you should have their own currency for the transactions. But if you go to Cambodia, you would see most of the shops, they are doing transactions using dollars. So that is referred to as dollarization or currency substitution. Now don't mix up this idea with substitutes. There is another term, currency substitutes or money substitutes. We are not talking currency substitutes here, but substitution or dollarization, which means using some other currency instead of national currency for their transactions. Okay, now let's move to the history of money very quickly, because we need to understand how the money has evolved over time. Why we need this understanding? We need to understand different features of money. We need to understand the efficacy of different money. Efficacy means how efficient they are in terms of transactions. So we need to understand it. For that matter, we go back to the history, and very quickly we will look at how the money has evolved in the history. So the evolution of money, we start with a system called barter system, right? Barter means, if you look at the dictionary, the idea behind barter means simply the exchange. So if someone says I'm bartering, which means you are exchanging something. So the evolution of money starts with this barter system. So barter system is basically a direct exchange system. That is the difference. Money is also exchange, but here we do direct exchange. What is the direct exchange? We exchange goods or services directly for another good or services without using a medium of exchange. To fit into the history, we might say very clearly exchange of goods, because services, let's put it in brackets, put some brackets, because sometimes it's very confusing. How do you exchange services. For example, can you exchange a haircut? You can't. You can exchange with some other service, right? In modern world, you might. But in the past, the exchange of goods directly for other goods was the idea, without using medium of exchange, right? You don't have any good or any asset in between. Now we have a very famous picture here. I have extracted this from Google for internet. Very famous for this barter system. This is the most famous example. So here we have two people exchanging fish and grain. Now what is happening here? These two people are exchanging directly fish and grain. Now if you look at this transaction, in between you don't see any currency, right? No currencies involved. So this person, he is having fish and he is exchanging this with grain. If you look at from the other person's perspective, he has grain and he is exchanging that with fish. Now what happens here in a barter system, people are exchanging the surplus of production with another party in order to get goods that cannot be produced. Now in this case, this person is producing fish, but he doesn't have grain. This person, he is producing grain, but he doesn't have fish. So in order to have the other good that is not produced by a particular person, they use the barter system. So what they have exchanged here is the surplus. The person who's producing fish is having more fish than what he needs. The person who is producing grain, he is having excess grain than what he needs. So this surplus can be exchanged to fulfill their needs. Now, in the barter system, this was the mechanism, and in a moneyless society, this is the only solution. In a particular system, if you don't have money, how do you exchange? Now imagine today, let's say you want to buy maybe a Christmas gift, right? Now you don't have money in the economy, so no one is basically injecting money and no money in the economy. So what is the only solution? If you want to exchange some gift with someone, person who's having, let's say, who's producing gifts, how do you get those gifts from him? You don't have money. So only solution is you are exchanging with some good that you have. Probably you are producing something else. So you give your production directly and exchange what you need directly. So in a moneyless society, this is the only solution. Barter system is direct exchange. But the barter system has very serious disadvantages. Okay, so very quickly, what are these disadvantages? So I have listed down here. What are the first disadvantage? I think this is the most severe one. Presence of double coincidence of wants. If you go back to this example, this person is having excess fish and he wants to have excess grain that is in excess with someone. So to get that, he gives fish. But imagine the person who's producing grain, he would say, okay, sorry man, I don't need fish from you. I need salt, right? If you have sold, just give me, otherwise I don't need. So look at the opposite. Let's say this person is having excess fish and someone wants to exchange grain. He would come to you and ask, I have some excess grain, can you give me fish? So you might say, sorry man, sorry bro, right? You use the word bro. Sorry bro, I don't need grain. I need meat. Do you have meat? So if you have, let's do the transaction. Otherwise, no. So double coincidence means there should be a match of the wants. So your need should be matched with the other person. But in barter system, it is a very difficult task. It's a painful task to find out a person who's having the same need as you. So this is a serious problem. I think in Sinhala you call it Womanawange Samapataya. Dvika Samapataya. Wants should match. Second, absence of common measure of value. There is no common measure of value, which means you don't know how much grain equals to fish. So this can be changed from person to person. So there is no common measure. Third one, indivisibility of certain goods. Certain goods you can't divide. Of course, grain you can divide. Even the fish you may divide. Let's say you exchange a cow. How do you divide? Which part you exchange? Which part is more important? That is a very crucial problem. So certain goods cannot be divided. That's an issue. For certain goods can be very, expensive to exchange or very large. If you look at this picture, you would see this guy says, sorry, I have got nothing smaller. So the smallest one he has is the cow. So what is the common measure? How do you divide? So this is an issue. So lack of standard of deferred payments. How do you pay debt? So when you are paying debt in a barter system, what is the standard? How much fish? How much cows? How much grain? So there's no standard, and also you can't store with. Have fish, that is very critical. How do you store excess? If you have meat, how do you preserve it for the future exchange? That is an issue. There is high search cost also, because whenever you need to find out a person, that takes time. Sometimes you might have to walk for a day or two to find out a person who needs the same thing. So that is high search cost. So all these point that the barter system, although at a primitive society it is helpful, it has series of issues, series of problems, series of difficulties in supporting transactions. So that doesn't fulfill the real idea of exchange in a society. Of course, it is really difficult in a modern society. Now, even in the modern society, we have some, elements of barter system. I know people exchange goods with goods, right? Some, vendors, they do such things, but it's very, limited and some special way of doing that. But other than that, the barter system is not popular, not prevalent in modern world. So that is the reason why money was invented. So the barter system was a failure in the history of human beings. So civilization, so people invented money. Okay? So when people invented money, that started with the idea of commodity money. So commodity money means for this transaction here, if you want to exchange fish with grain, if you can't do it directly, as it has a lot of issues and disadvantages, people introduce some strange item, some third-party item to facilitate the transaction. So that is basically the origin of commodity money. So an intermediate commodity was used to resolve the double coincidence problem. So even if I don't want fish, I might need something else in future. For that matter, I might need some another commodity. When I have that commodity, I can buy whatever I want in the future. So that commodity money was used as a store of value. You keep it and use it later for your transactions. So here we have the definition of commodity money. This is important. Commodity money means money whose value comes from a commodity out of which it is made. So the value of money equal to the commodity. That is the idea. In other words, the good is used as money. You call it the intrinsic value. INTRINSIC. Intrinsic. Intrinsic means the value of commodity equals to value of money. For example, if you take a gold coin, the value of gold equals to value of the coin. That is the idea. Very general definition. But at the early stage, it was not the case. Early stage, even for the case of commodity money, it's really, difficult to understand how the value was determined. Why? Early type of money used in the past was things like this: shells, cowrie shells, cattle, salt. These are the commodities used in the very early stages. So which means if you want to exchange fish and grain, you use shells. You use a cow as an intermediate commodity. So this was a difficult task, as I said. How do you determine the value and all that? This came as an issue. So later on, people use precious metal, gold and silver, as commodity money. So these are some early forms of commodity money where you have, this is very common as a horseshoe money, and there are also spade shape money, right? So metal were used in those shapes in early stages. Later in the human civilization, people changed the shape of this metal into a similar coin. Now this coin is the very famous and oldest coin in the world. It is called Athenian owl, right? Athenian owl means where is Athens? Athens is in Greece, right? So the Greek civilization is basically before Christ, right? 3rd century, 6th to 3rd century. Basically during that period, this commodity was introduced. Commodity money was introduced using silver. Later on, people changed to gold. So silver and gold were used in many parts of the human history as commodity money. Later on, during very developed stages of human history, these commodity money, gold and silver coins, were made in good shapes and good weight, and also with some, styles, designs. Right? If you look at the history, the Western history, the Asian history, you will find these various coins, metal-based coins using commodities like precious metal. Even in the case of Sri Lanka, we find the last coin I have put it here. This is coming from Sri Lanka, I think 12th century. What is the kingdom of 12th century? The monarch is basically the Polonnaruwa reign, right? Polonnaruwa kingdom. So during that period, some kings like great Parakramba, Unishankamal, they minted coins, right? So this is very famous Polonnaruwa coin with this, king's portrait. So there also you use commodity like gold. Probably you may have heard the terms the Kahapan. If you have read some, ancient Buddhist stories like Jataka stories coming from India, they are also in those stories. Also, you see these terms. Kahavan. Kahavan means basically made out of gold or gold-plated coins. All are treated as commodity money. So, if you look at the most part of the human history from the BC, before Christ period, to the modern dates, especially at least to 15th century, almost 1800 years, we see the evolution of commodity money, metal-based money. Even though it has been used for many years, many centuries, it has various advantages as well as disadvantages, right? So given the interest of time, let's stop at this point and we'll start our discussion next week from the from this point onwards, advantages and disadvantages of commodity money, and then let's look at the other forms of money. Now, before we stop here, two announcements I would like to make. As I said, we don't have classes next week, but we are meeting on in week after, I think 2nd January. I would like to remind you, you have to come up with your ideas when you read the budget speech. Especially, I want to see what you find in the budget speech related to the financial sector, right? I'll remind you halfway through your LMS model, and I really expect you to work on that. Okay. And please be ready with the calculator. As I said, probably we might have calculations, may not be the next week, but for this lesson, you have to have a calculator with you, right? Okay, let's stop at this point, and I wish you happy festive period. Merry Christmas and Happy New Year. Stay safe, and hope to see you in 2021. Okay, good luck and all the best. Thank you.
Thank